Hello, welcome back to the continuing lecture in investment analysis. So we were talking about the arbitrage pricing theory. We just got started on that in the last video. And actually, Stephen Ross in 1976 came up with arbitrage pricing model. And it's basically, as I explained in the last session, it's based on the long run equilibrium security market line. In other words, in the long run, the security market line will prevail, but in the short run, there is a mismatch or mispricing. It can exist. The disequilibrium can exist in the short run, and it's based on the market efficiency hypothesis. And the reality of the market is that it is not strong form efficient, but rather weak to semi-strong form efficient. It allows for the possibility of short-run disequilibrium to exist. So if the short-run arbitrage exists, then there exists a strong pressure to restore equilibrium. Yeah, we all understand. If there's a mispricing, everyone wants to take advantage of that mispricing, right? Especially if it is underpriced, then that's what there will be a strong buy demand for that, which will apply upward pressure on the price, and the price will eventually go up. That window of opportunity will close very soon, right? So then, how do you apply this? How do you apply arbitrage pricing model? So let's assume a portfolio P with positive alpha. Okay, and it has a positive alpha against what? It has a positive alpha. So we have to use a benchmark portfolio with beta of 1, right, to hedge away or purge the systematic risk of the portfolio P. Okay, this P will be our arbitrage portfolio. So we will need to convert it to, we will convert this P, portfolio P, into a zero beta portfolio. Zero beta means, it's not affected by, however the market moves, it's not going to be affected. Right? It will always give you that alpha. Can even turn the positive alpha zero beta portfolio into a we can even turn that positive alpha zero beta portfolio into a zero net investment position by adding an appropriate position in risk-free asset. Yeah. So zero net investment position means you short sell something, right? Like risk-free assets. And with the proceeds, you invest in the long position. So then there is no net investment, right? So in all, combine the positive alpha portfolio P with both benchmark and treasury bills to create a costless zero beta portfolio A. So arbitrage, A stands for arbitrage. So arbitrage portfolio with a positive alpha. So this is still, very conceptual, and it doesn't give you a strong grip on it. So we'll have to take a look at an example what this means. And first of all, it's important to make distinction between benchmark portfolio and the this risky portfolio P. Okay, and the benchmark portfolio will be the broad market. So let's take a look at this. So I think we should take a look at the example if possible first. So here benchmark, but I will I will switch between this example and the theoretical model as we go along. So benchmark M is observed broad market index including 4,000 plus stocks. I mean, in other words, S&P 500 is relatively good. I mean, 500 companies, 500 stocks represent the pretty much the entire cross section of the entire economy, but it's not the really true financial market. And as has been discussed over and over, true financial market is not observable. I mean, exactly or completely observable, because there's constantly in flux. I mean, it should include stock market, bond market, real estate, commodities, foreign exchange, and all of these really, 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 really broad market is hard to define consistently. You understand? There are constantly, items that gets added in or, drops out. So it's only a real, broad market is, only a conceptual thing, right? So benchmark is, a broad market, and New York Stock Exchange, Nasdaq, and Amex all combined, still, that's only conceptually, benchmark. So before, let's get back to, so that would clarify, I believe that should clarify what benchmark portfolio is. And these are the portfolio weights. If you put, all of your funds, capital into our portfolio P, and let's say in this, our risky portfolio is S&P 500, let's say. Okay, and then our S&P 500. Why? I mean, isn't S&P 500 a benchmark? No. Usually S&P 500 is being used as the market index benchmark, but in arbitrage pricing model, benchmark is really comprehensive, very extensive, broad market index. So it's like, Russell 4000, Nasdaq plus, uh, uh, American Amex and NYSE, all very expansively pulled together, right? That's the benchmark. And then there is and between benchmark and S&P 500, there is a certain correlation, obviously the beta, right? And the beta between the our portfolio and the benchmark is, let's say, some negative number, right? So like negative negative 0.95, okay. Oh, negative 0.95 is really huge, but let's say negative 0.5, right? Negative 0.5. That means when our benchmark is when our benchmark is going up 1%, the entire the broad, I mean, that means when our portfolio is going up 1%, our broad broad benchmark is going down by 0.05%, right? So this is a slight misalignment. You see what this is, there's a slight misalignment between the broad financial market and the our portfolio, which is S&P 500, right? And then this gap will be filled by, think about it, this 0.05 gap will be filled by T-bills, okay? So, and think about it. So if the beta is 0.05, then the risk-free weight of the risk-free will be 95%. So think of it this way. So you're shorting, you're putting all your money into S&P 500, and then let's say it is $1 million, and then you put you're shorting 950K, right? You're shorting the T-bill for 950K, and you're shorting the benchmark by 5K. I mean, 50K, right? So first, you're shorting, short selling, the benchmark by 50K, and shorting T-bill by 950K. And then, because you're short selling, there's a proceeds, total of, $1 million. And you use that money and put it into S&P 500 portfolio, right? Then this is zero net investment, right? This is zero net investment. Right? And let's take a look at the contribution to excess return. Of course, the contribution to the excess return from our, portfolio, and in the example, this will be S&P 500. It will be, the systematic part and, non-systematic part. That will be, right? If there is any, whatever, whatever return on the S&P 500 or in our portfolio, P is, that will be it, right? If the return on S&P 500 is 10%, we get 10% return without any of our money being put into that. But, by shorting the benchmark and risk-free asset, right? So zero, let me, let's say, S&P. And then, by as much as the weight, it will contribute to the excess return. And by as much as, its weight, right? And, it's because, beta is negative, it will be, if ever, counter, contributing, counter contributing to the excess return. And there's no excess return in risk-free T-bill, right? So when alpha is negative, you would reverse the signs of each portfolio weight to achieve a portfolio arbitrage portfolio with a positive alpha and no net investment. Yes, if you flip the sign, when alpha is negative, then if you flip the sign, in other words, then you would make this negative, you would make this positive, right? And then flip the sign and eventually, in other words, reverse short, right? In this example, we shorted the benchmark and the T-bill, but if the alpha is negative, then you reverse it. You short the S&P 500 and put the money into the proceeds from short sale, put the money into a T-bill and broad market. So APT will give you this type of result, and well-diversified portfolio is important, and we're gonna talk more about that shortly, because if the portfolio is well diversified, the expected error term will be a white noise, right? And words I'm gonna should I use? Yeah. If it is well diversified, meaning okay. So portfolio A, arbitrage portfolio with excess return, alpha P plus alpha portfolio, alpha of the portfolio and residual of the portfolio is still risky, as long as, it's still risky. And this isn't, it shouldn't be risk. It shouldn't be risky. It should be risk-free. I mean, by the definition of true arbitrage, right? It should be a zero net investment, risk-free model, right? But if as long as the variance of the error term is positive, then it is not riskless yet. It is still risky, right? So that means if it is not well diversified, right? If the portfolio is not well diversified, it is still risky. However, zero investment, zero beta, a positive alpha portfolio is not necessarily arbitrage opportunity. True arbitrage implies no risk. However, if P were highly diversified, its error variance or residual variance would be very small. A portfolio with that would make it practically negligible, right? A portfolio with practically negligible residual variance is a well-diversified portfolio. So here, we understand why, a well-diversified portfolio is important, because you won't see these, right? These are the residuals, right? These are the residuals, and as long as and if you square them and sum it and square these and sum and divide it by n-1, and that's the variance, isn't it, right? And if the variance is positive, then it's not riskless, right? But if you if it is a well-diversified portfolio, right, and you've seen this from Finance 100, right? All these non-systematic risks, the financial risk and business risks, they all cancel out each other. So the return will be the residual regression errors or the residuals will be zero. They will neatly fall on the regression line, and you will have only positive alpha. Hi. Come on. It's hard to draw. That looks like alpha. Doesn't look like alpha. Okay, whether it looks like alpha or not, I give up. So non-systematic risk is negligible in a well-diversified portfolio, and positive return, zero net investment, it will become a positive return, zero net investment, risk-free portfolio. So an arbitrage portfolio is a money machine. It can generate risk-free profit, and you can scale it up as much as possible, financing it with as much leverage and or as many short positions as possible. Short position is like a leverage, isn't it, right? I mean, if you short, T-bill, what does that mean? You're borrowing money at T-bill rate, right? So they short, it's like leverage, right? Shorting T-bill. So let's. This brings us to the finally to the this example. So benchmark. We already talked about this. Following 5-year predictions, right? On December 31st, 2005. So we're at the end of 2005. So 5-year forecast will start from, right, January 1st and of 2006 all the way to December 31st of 2010, right? Now, we're taking these forecasts, predictions from some, data source like, Morningstar or, value line. So cumulative risk-free return from rolling over T-bills over the next 5 years. So the cumulative return, right? I always, it's been my, I've known it all this, all my life, that cumulative is the correct pronunciation, but there's an alternative pronunciation, cumulative, which is relatively a minority. Most minority linguistic habit or linguistic group. I mean, the majority of the population pronounce it as cumulative, but there would be, some minor group of people who pronounce it as, cumulative. But either way, cumulative risk-free return from rolling over T-bills over the next 5 years is estimated at 11.5%. Then if you annualize it, geometric average, right? If you annualize it, it's going to be 2.2%. Well, please verify that. How do you know? Well, you can easily do that. How? Look, if it is 11.5%, you raise it to okay. Please verify. Let me. I haven't. I'm giving you. I haven't done it yet, but I know why. I know how. So it should give you exactly. And why do they do that? Well, because these data from, like value line, or I mean, all this is, the forecast. They give you like 5-year forecast, and this 5-year forecast is generally based on arithmetic average. If you use, arithmetic average, and roll it over for 5 years, and that kind of forecast is very, accounting, uh, uh, accounting's, uh, way. I mean, they do. Uh, because, cash flow projections, are basically generated by, accounting, principles, right? So raise it to, yep, exactly 2.2 you get. That's, geometric average, right? Because um, this 11.5, as I said, is based on, 1-year T-bill rate, simply, and uh, and they must have, and based on 1-year T-bill rate, uh, they use that, assumption of rolling over 5 years, and uh, so usually, through accounting, uh, uh, what they, practice in accounting, they just make average of, simple average of, 5 years, and uh, but, we know, what I'm trying to say is, that kind of projection is, based on a very, very simple, uh, simplified assumption. Um, because 1-year T-bill spot rate will change over time, right? Um, unless you put your money into like a 5-year treasury note, right? No annual rate is guaranteed. If you're putting your money into a 1-year T-bill, right? This year, 1-year T-bill rate may be, 1 point something, 1.5. Next year, that spot rate uh, may not be 1.5. It changes, but, so uh, usually, accounting accountants uh, uh, use, just uh, like, projecting cash, flow, or they use simplified assumption, and the simplified assumption is usually, some uh, uh, simple average. Now, cumulative return on uh, the broad market is estimated uh, at 20%. So this is also 5 years. And if you do the same thing, you'll get the geometric average of, annualized return of 3.71%. And S&P 500 is your portfolio, right? This is our. And it's composed of, large capital, large cap, believed to be overpriced. Because it is large cap, it is believed to be overpriced. That's why, that's why they assume negative correlation between the benchmark, even slightly negative correlation between the benchmark and our S&P 500. So the expected holding period return over 5 years, or cumulative expected return, is forecast at 12%. And if you do the same thing, annual rate of 2.29. And S&P 500 beta against market is estimated at 0.95. Because our broad market is always one, because, think about it, beta of our broad market, the benchmark, is always one, because that is the, and S&P 500 beta is against M is, 0.95. So the return on our portfolio S&P 500 will be, of course, RF. This is the risk premium, right? Risk premium on. It's not the risk premium just yet, because the uppercase is, normally the risk premium, but it looks like it's not risk premium. Actually, it should be a lowercase. I don't know why, but that's fine. Let me. I will correct this later, because if it is risk premium, then you shouldn't even see RF here. So this is just the return, expected return, or the required return on our risky portfolio using capm, right? We know it's supposed to be 2.29, because that's annualized return on our P. And we know 2.2 is risk-free plus alpha plus, beta of S&P 500, and do this. And alpha comes out as negative 1.34. And since alpha is negative, then we reverse the weights in table 7.5. Okay, so then we short S&P 500, right? The weight in the S&P 500 is negative 1. Weight in the market is negative 0.95, and weight in the risk-free T-bill is 0.05. Then we will always achieve risk-free alpha of 1.34. Okay, so look, it's, just we're running out of time, so we will have to revisit this table in the next video. But this gives you get the idea. This is how you exploit that risk-free alpha, right? Alrighty, so I will have to cut the video here, and we'll see you guys in the next video. Stop recording.